Financial markets have always moved through cycles of growth, stability, uncertainty, and recovery. Throughout history, every major financial crisis, from the Great Depression to the global financial crisis of 2008, and more recent periods of economic instability, has reminded investors that markets can change rapidly. While no one can predict exactly when the next financial crisis will occur, or how severe it might be, experienced investors understand that economies often display warning signs long before major disruptions unfold. Recognizing these signals does not mean trying to predict every market correction. Instead, it allows investors to better understand changing economic conditions, manage risk more effectively, and make informed decisions based on facts rather than fear. It is also important to remember that market downturns are a normal part of investing and do not always develop into full-scale financial crises. Successful investors prepare for uncertainty rather than attempting to forecast every market movement. In this video, we will explore some of the most important financial crisis signals that investors should monitor, explain why they matter, and discuss how long-term investors can respond thoughtfully without making emotional decisions. Today, we will talk about the financial crisis signals every investor needs to watch right now. So, before we start, make sure to hit the like button and subscribe to my channel. Why financial crises do not appear overnight. One of the biggest misconceptions about financial crises is that they happen suddenly, without warning. While unexpected events can certainly trigger market volatility, most major financial disruptions develop gradually as economic imbalances build over time. Rising debt, weakening corporate earnings, slowing economic growth, excessive speculation, banking stress, inflation, and tightening financial conditions often create pressure long before markets experience severe declines. Understanding these underlying trends helps investors recognize changing economic environments instead of reacting solely to dramatic headlines. Rising interest rates can slow economic growth. Interest rates influence nearly every part of the economy. When central banks increase interest rates to control inflation, borrowing becomes more expensive for consumers, businesses, and governments. Higher mortgage rates may reduce housing demand, businesses may delay expansion projects, and consumers may spend less as loan payments increase. While higher interest rates can successfully reduce inflation, they may also slow economic activity if maintained for extended periods. Investors closely monitor central bank decisions because monetary policy often influences stock markets, bond markets, real estate, and business investment. Persistent inflation remains an important signal. Inflation measures how quickly prices for goods and services increase over time. Moderate inflation is generally considered normal within healthy economies, but persistently high inflation can reduce purchasing power and create uncertainty for businesses and consumers. Companies may face higher production costs, while households experience rising living expenses. Investors watch inflation carefully because it affects corporate profits, consumer spending, central bank policy, and long-term investment returns. Slowing corporate earnings growth. Corporate earnings remain one of the strongest indicators of business health. When companies consistently report slowing revenue growth, shrinking profit margins, or declining earnings, investors often become concerned about future economic conditions. Lower consumer demand, rising operating costs, supply chain disruptions, or weakening business confidence can all affect profitability. Although temporary earnings declines occur regularly, widespread deterioration across multiple industries may signal broader economic weakness. Increasing unemployment can reduce consumer spending. Employment plays a critical role in economic growth because consumer spending represents a significant portion of many national economies. When unemployment begins rising, household income often declines, leading consumers to reduce discretionary spending. Lower consumer demand can affect business revenues, corporate profits, and future hiring decisions. Investors monitor employment reports because labor market conditions often reflect the overall health of the economy. Consumer confidence matters even when economic data remains relatively stable. Declining consumer confidence can influence future economic activity. If households become concerned about job security, inflation, or financial stability, they may postpone major purchases, reduce discretionary spending, and increase savings. Since consumer spending supports many industries, declining confidence may contribute to slower economic growth. Surveys measuring consumer sentiment often provide useful insights into changing economic expectations. Excessive debt creates financial vulnerability. Debt itself is not necessarily harmful. Businesses borrow to expand, governments finance infrastructure, and consumers purchase homes through mortgages. Problems arise when debt grows faster than the ability to repay it. Excessive borrowing increases financial vulnerability during periods of higher interest rates or slowing economic growth. Investors monitor government debt, corporate debt, and household debt because high leverage may amplify financial stress during economic downturns. Banking sector stability is essential. Banks serve as the foundation of modern financial systems by providing loans, processing payments, and supporting economic activity. Financial stress within banking institutions can reduce lending, increase uncertainty, and affect broader economic growth. Investors monitor bank earnings, loan quality, liquidity, capital reserves, and regulatory developments, because banking stability often influences confidence throughout financial markets. Housing market conditions provide important clues. The housing market often reflects broader economic trends. Rising mortgage rates, declining home sales, falling construction activity, or increasing mortgage delinquencies may indicate slowing economic momentum. Housing influences employment, consumer spending, construction, banking, and household wealth. Although housing cycles naturally fluctuate, significant weakness within the real estate sector sometimes contributes to broader financial challenges. Stock market valuations require careful attention. Strong stock market performance does not automatically indicate excessive risk, but unusually high valuations relative to corporate earnings may suggest increased investor optimism. During periods of excessive speculation, investors sometimes pay prices that become difficult to justify based on business fundamentals. While high valuations alone do not cause financial crises, they may increase market sensitivity if economic conditions deteriorate or corporate earnings disappoint expectations. Geopolitical risks can influence markets. International conflicts, trade disputes, political instability, sanctions, cyber attacks, and diplomatic tensions can all affect global financial markets. Geopolitical uncertainty may disrupt supply chains, increase commodity prices, reduce business investment, and create volatility across financial assets. Investors cannot predict geopolitical events, but understanding their potential economic consequences helps improve long-term risk management. Credit markets often provide early warnings. Professional investors frequently monitor credit markets because they sometimes reveal financial stress before stock markets react. If businesses face increasing borrowing costs, or investors demand significantly higher returns for lending money to financially weaker companies, it may indicate growing concerns about economic conditions. Credit market behavior often reflects changing perceptions of financial risk across the economy. If you liked this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.